All right, good afternoon. Welcome to the ABAS course again. This is the third accounting class. Now, before we start, just want to give you a short review and overview of what we have done, what we're going to do in next 1 or 2 weeks. So remember in class 2, we reviewed the very basic accounting knowledge, accounting principles, and we went through the journal entries. We discussed how to prepare financial statements based on the source documents. Okay? So in the second week, that is last week, we discussed accounting manipulations, how we can identify accounting scandals, how we can analyze accounting quality, how we can redo the accounting distortions. This class, we will discuss financial analysis. So we are going to use ratio analysis in particular to assess companies' performance, operating efficiency, and financial risk. That is critically important for any users of financial information. Now think about an investor. Before you make investments, you have to say whether the company is a good or bad one. How do you make the judgment? You have to assess its performance based on some accounting numbers. So ratio analysis has been widely used by financial analysts. If you are a banker or if you are a credit analyst working in a bank, before you give a loan to a borrower or a company, you also need to assess its financial risk based on the ratios. So this class, we are going to discuss in detail the ratio analysis. Next week, we are going to talk about valuation from the perspective of investors' point of view. Okay? Before you invest, you have to make sure that a company has a good potential to have a share price increase in the future. You don't want to buy a company whose price will drop in the next few days. Okay? So that is the plan. Now, for ratio analysis, again, that's nothing new for accounting students, also for finance students. You probably have learned that in previous courses. Now, you have learned what kind of ratio you want to look at, how to say if they're good or bad. In this class, we want to take you to one step further. That is, we want to examine what drives these ratios and how those ratios could help us to make predictions. Okay. So this class would be slightly more advanced than what you learned before, but now in the first half an hour, we're going to go through the basic ratios. That's the same as what you learned before. In the second half, and also the second part of this lecture, we're going to give examples to show how we can actually perform this ratio analysis at a high quality or high advanced level. So we'll talk about basic principle, we examine different ratios, and after the break, we're going to use Walmart and Target as one example to show you how a professional financial analyst should conduct ratio analysis. It's not just basically do this calculation and say it's increase or decrease. We want to do more. The reading is based on this textbook in chapter 7, okay, and also the lecture notes. Okay. So let's start. So when you do ratio analysis, basically you take 3 steps. Number 1, calculation. So you are given the ratio or the formula, then you find those relevant accounting numbers from financial statements, you do the calculation. For example, we talk about ROE, return on equity. That is net income divided by equity. So you need to remember some of the ratios. Okay. Number 2, interpretation. So you have to understand what this ratio can tell you. Again, like ROE, return on equity, we're going to discuss a bit more in the next few slides. Like, this is a measure of profitability from the point of view of investors, because equity is provided by investors at the beginning of the year. Okay, I give you $100 as equity at the end of the year. How much earning you give back to me? So that's the idea of a return. The highest return or the high ROE suggesting this company is doing better, okay, because it can return more money, more profits to shareholders. Okay. So that's the basic understanding for the ratios. You should understand such meaning for every single ratio in your analysis. Last step is analysis. I put this as the last. Understanding what it means is not the end. More importantly, we want to say when you say ratios change from last year to this year, what does that mean? What drives the ratios changes? Why I want to understand that? Because this change, or the reasons behind the change, can help you to make predictions. Okay, we're going to say this later on when we discuss the ratios. So remember 3 steps: calculation, okay, interpretation, and analysis. Most of ratio analysis you have learned so far focus on the first 2 steps. Okay, very few courses will tell you how to do this analysis, and that is the focus today. So probably have done this. Ratio analysis is all about comparison. A single ratio does not tell you too much. Like if I tell you ROE is 10%, okay, well, certainly it's better than 0% or negative 1, okay, but don't tell you anything more than that. We have to make some comparisons. Okay, we have to compare the ratio with some kind of benchmark. In this case, basically we have 2 approaches or 2 comparisons to make. First one is time series comparison, in which case compare this year's ratios with the historical ratios or ratios in previous years. You want to assess whether the ratio is getting better or worse. Second one is cross-sectional comparison. You want to compare company A's ratios with company B's ratios and make the judgment which company is better. Okay. So those are 2 basic methods to make a comparison. Now for time series comparison, okay, we want to examine how ratios change over time. And when we do this comparison, it's very important to make sure accounting policies are consistent over time. If there's change in accounting policies, those numbers are not directly comparable. A simple example is, as we discussed last week, change in the depreciation policy. Okay? Suppose I'm Qantas. I have 12 billion aircraft sitting on my balance sheet. Depreciation is a large part of my expense. Suppose last year, I estimate depreciation for the aircraft is a useful life of 10 years. And this year, I change that to 15 years. And immediately what you can say is this change will affect your depreciation expense and your earnings. So if you use different accounting policy or any change in accounting policy, that could make those numbers not comparable over time. Now the good news in this case is for depreciation policy changes, company has to disclose how this change would affect reported numbers in the past. They have to do this calculation backwards to show investors if we use 15 years useful life, how the numbers in the past 2 or 3 years would have been changed. So you can just pick those numbers and do this calculation. But the key point here is, again, before you do ratio analysis, you have to conduct accounting analysis first, understand accounting assumptions, accounting policies behind those accounting numbers. Okay. Now, when you do this analysis, what could change the ratios over time? What are the reasons behind the changes? Now, basically, you try to look for 3 factors. Number 1 is economic conditions, whether we have economic boom or economic recession. For most of the companies, the ratios are moving together with economic growth. In economic boom periods, every company, not every company, but most companies will do very well. It's a high growth rate in sales, high profit margin, high turnover ratios. Okay, everything looks good, high return to equity. Okay. In bad times, like recessions, they could report losses, so their profitability is low, ROA, ROE is low, turnover ratio is low. So that is the first or the most important factor affecting most of companies' ratios. We need to understand that. Okay. Second one is industry conditions. Some industries are growing, some are declining. When you are different, or at a different life cycle of an industry, or simply because you are in different industry, your ratio could be very different. Again, in a growing industry, you could have a high growth rate, high profit margin, okay, because competitions will be weaker relatively. If you are a declining industry, the market size is getting smaller, then your profit margin will be squeezed by competition. And then your growth rate could be negative, your turnover ratio could be low as well. And also in the declining industry, you could have high financial risk based on some coverage ratios, based on cash flows. So we have to examine that as well. And the last one is first specific conditions. Okay. So company, even if they are operating in the same industry, they could have different strategy, different management team, different products, slightly different products. Okay? So those factors could again affect the ratios. Okay? Now, for example, okay, if a company make a bold decision to enter new markets, okay, then you could say it has high growth rate in its sales revenues. And the enter new markets could also open opportunity for growth rate for sales and also profit margins. Okay? So this kind of strategy could affect companies' growth. Okay? And the other one, okay, if you just grow in existing markets, sometimes market could be saturated. Okay? And there's some spillover effect. We open more and more stores, incremental sales getting smaller and smaller. Okay? And that strategy, because of saturation in the market, could also drive down your profitability over time. So those are three factors. They take them into bear in mind. So those are things we're looking for. Now, definitely, it's very hard to pin down which one accounts for how much. For example, if you say our company's ROE increased from 10% to 15%, okay, all the three factors could contribute to some degree to this 5% increase. Okay? But we need to understand why. Okay? Next one is cross-sectional comparison. In this case, you want to compare ratios with the peer firms' ratios, and they in the same year. So those industry-wide conditions, economic-wide conditions will be held constant. Okay? You're comparing the different company operating in the same industry at the same point of time. And then you try to evaluate the firm's performance relative to the peers. Now, when we do cross-sectional comparison, it's very important to find the right peer firms. Okay? We want to compare orange with orange. You don't want to compare apple with orange. Now, where do we look for peer firms? We typically look for companies in the same industry, producing similar products, have a similar strategy, age, and size. All these could play a role affecting your ratios. Okay? Industry is understandable. Okay? Quantas ratios could be very different from, say, the banks. Okay? They're in different industries. Operations are different. Regulations are different. So those ratios are not comparable. So you want to compare Qantas with Virgin, okay, or Virgin Australia. So both are airline companies in the same industry producing similar services, so the ratios could be comparable. So that's what you're looking for. Corporate strategy could also play a role as well. Okay. If you have done course in strategic management, you understand that basically a company has two strategies to compete: differentiation and the cost leadership strategy. Differentiation means, as a company, you want to make sure your products are better, so you can charge a price premium, okay? And consumers are willing to pay a higher price for your products. That's differentiation. Okay? In the cost leadership strategy, like Coles or Woolworth, your strategy is try to push down your cost. Okay? Be the cost leader in the industry. With a low cost, it can offer a low price to attract more customers. So those are two basic strategies. Now, once you think about the two strategies, you can understand they could affect your ratios. Okay? For differentiation strategy, typically, you will get a high profit margin, okay? Because you want to charge a price premium, high price for the same products. You get a high profit margin. For the cost leadership strategy, okay, you push down cost because you want to offer low price. So low price strategy, okay, basically, will push down your profit margin. Okay? Different strategy give you different profit margin. Age and size also have a role to play as well. Typically, large company, older company, tend to have a slower or smaller growth rate. Okay? Young company, small company, tend to have a high growth rate. Okay? And in terms of the financial leverage or financial risk, now typically, small company, young company could have high financial risk. Okay? And because they usually have a very small operation, and it's very easy for the operation to be negatively affected by the industry shocks or economic shocks in the market. For large companies, older companies, they tend to have a more diversified operations in different industries, in different segments, and when negative shocks happens, they are more likely to help themselves. And also, if you are a very big company, you could have the issue of too big to fail. You could get rescued by the government. Okay? That's the situation we saw for those big banks in the financial crisis periods. Okay. So they have different degree of risk. Now, after seeing that, when you come to this analysis, sometimes you may realize it's not easy to find the right or perfect benchmark or peer firms. Okay. In many cases, every company is kind of different, it's kind of unique. It's not easy to find the right benchmark. For example, okay, if you want to analyze JB Hi-Fi, okay, to do that company for your project or for your investment analysis, which company would you choose as a benchmark to analyze JB Hi-Fi's ratios? Have you been to JB Hi-Fi's stores? And you know what they're doing, right? So which company would you choose as a peer firm for JB Hi-Fi? That's not a difficult question, right? Many of you would naturally choose Harvey Norman. Okay? Or some people get surprised. So which one would you think more or better than Harvey Norman? Some people say Bing Lee. Yes, they're selling those electronic products, but Bing Lee is a private company. You don't get financial statements for Bing Lee. Okay? Dick Smith died a few years ago. Okay? So you probably just left with this Harvey Norman. Harvey Norman would be a good choice because they also sell those electronic products. Okay? The issue is, do they sell exactly the same products? Nope. Okay, at least a few years ago. Okay. Now, a few years ago, JB Hi-Fi was a pure retailer of electronic products, CD, DVD, and those computer games, okay, or TV, as home appliance. But JB Hi-Fi Harvey Norman has two segments. One is electronic products, almost the same as the JB Hi-Fi. Second one is furnitures. Okay. Now we have these slightly different products. How does it affect the ratios? Okay. Think about the inventory and turnover ratios. Okay. Which company would you expect to have more inventory? Harvey Norman would have more inventory. Why? And also lower turnover ratio for the inventory. The reason is it takes more time to sell those furnitures, okay, than selling those electronic products. One reason is on average, electronic products like your computers or phones or laptops usually have a short life cycle, 6 months to 12 months. If you don't sell those computers in 6 months or 12 months, they could be out of dated. They will be replaced by new model. So you have to sell faster. For that reason, don't want to store too many of those computers in your stores. Okay? And for that reason, the turnover ratio, or how fast you can sell those computers, will be high. Relative furnitures, okay, furnitures have a relatively longer life cycle. You can sell the same piece of furniture for 3 years or 5 years. Okay? Actually, if you go to IKEA, another furniture retailer, sometimes their products could have a useful life, a life cycle more than 10 years. I remember about 2007 when I came to Australia, I went to there to buy some furniture. Okay. Just a few weeks ago, I went there again with my kids because there's a small land they can play there. So I went to see the store again. I found the same piece of furniture still on sale. Okay. So what you see here is these furniture can have very long life cycle. So you don't have to sell them very quickly. Okay. And for that reason, okay, their inventory could stay there for a long time period. Okay. So what you see here is that even though they're quite similar, but because they have different products, they could have a different inventory level, inventory turnover ratios, yeah, and those could affect your operations. They could have different strategies as well. The strategy for JB Hi-Fi is very clear. Cost leadership. They don't have warehouse. All the inventory is stored in the store. What you say is what you're going to get. Now, JB Hi-Fi has cost leadership strategies. They also don't give you too much service. Now, Harvey-Norman tend to do a bit of differentiation. Okay? So they provide slightly better customer service, give you a bit more choices, give you financing options. Okay? So that again affects the ratios. As we said, different strategy will give you different profit margin. Okay? So those are things affect these two companies, even though on the face value they look very similar. But when you dig a little bit deeper, you could see the difference. Now, what should you do in this case? Should you just say, no, we can't use Harvey-Norman as a benchmark? Now, in this case, my advice is you try to find the best available in the market to do the analysis. And when you do the analysis, you have to take into account some differences in ratios may be driven by the differences in the company. Okay? Not because company A is better than company B, just because they have different strategy, they have different products, they could have different ratios. And we need to take that into account. So my advice to students selecting JB Hi-Fi and they compare JB Hi-Fi with Harvey-Norman is, yes, you can do that. Okay? Because we still think, even though they have some differences in the operation in the products, but these two are the best available in the market as peer firms. Okay? If you find any other company, that could be even worse. Okay? The difference could be even bigger. Okay? The only thing is that when you compare JB Hi-Fi with Harvey-Norman, you have to bear in mind some difference in the ratios like profit margin, term ratios may be driven by the differences in the products, differences in the strategy. Okay? And also, whether you choose JB Hi-Fi or Harvey-Norman, it's always a good idea to do both time series analysis and a cross-section analysis. Okay? And that, because in time series analysis, you control the firm itself, look for the change in ratios. Okay? So that will give you more insight. Another choice is industry average. Okay? Many firms and analysts like to use industry average as a benchmark. You can simply tell whether your performance is above or below industry average. Okay? Now, the only issue here is if your company is close to industry average or similar kind of average firm in the industry, that's fine. Okay? Or every company in the industry is relatively of same size, okay, that is okay. But your industry is different, you are far away from the industry average, then that average may not be relevant, okay, for you as a benchmark. Okay. As we'll talk about the auditing industry, you have a big four auditors, non-big four auditors. Okay. Big four dominates large companies, okay. Non-big four provide services for smaller companies. In this case, the industry average could somewhere in the middle, which is not a good benchmark for either big four or non-big four. You probably, in this case, you want to examine two different benchmarks. You compare big fours with themselves, compare non-big four with other non-big fours. Okay. So industry average sometimes could be misleading. So those are general principles. Now, next one, before we start, some keywords you have to bear in mind all the time. First one, there is no standard way to compute many ratios. If you take a different course, if you have different textbook, if you go to different website, you could say different definition for the same ratio. One example that has been kind of misused in many different ways is the leverage ratio. Okay. There are at least dozens of definitions for leverage ratio. We can compute leverage ratio as debt divided by equity, debt divided by total assets, okay. Total liability divided by equity, or total liability divided by equity or total, the assets. You can also just use the short-term debt plus long-term debt divided by assets. Okay. And later on I'm going to show you, we can also use total asset divided by equity. Okay. That is also a way to define leverage ratio. So it's very confusing here. They're all called leverage, but they have different definition and different way to compute that. What should you do? It's very important to make sure you know how ratios are computed before you interpret them. Okay? Because debt divided by equity will be very different from debt divided by total assets. Okay? In this case, you have to make sure you know the formula. And also important to be consistent. That is, you use the same formula to compute the ratio for all the companies for all the years. Okay? So consistency can be more important than which specific formula you choose here. Okay? Now, in your exam, if you are given the question to compute the leverage ratio, for example, the first thing you need to do is write down the formula. Okay? So it doesn't matter whether it's debt to equity or debt to assets. Have to write down that first. Then you do the calculation. Okay? Another thing is if you go to some website like Yahoo Finance or Bloomberg, they sometimes report this leverage ratio. Before you interpret the ratio, you have to ask how the ratio is computed. Otherwise, again, it's hard for you to understand what it means. Second thing is like magic. So ratios don't tell you answers. They just tell you where to look for answers. Okay. So we calculate ratio, interpret ratio, that's just a starting point. That's not the end. Okay. We need to do analysis. You need to understand why ratio changes, why company A's ratios are better than company B's ratios, what are reasons for the differences. And more importantly, you probably try to predict how those factors will change next year or in the future years, because as an investor, what we really are interested in is the future. Future share price, future operations. We're less interested in the past. We try to understand the past because understanding past can help you to predict the future, but understanding the past is not the purpose. The purpose is prediction. Lastly, accounting ratios or based on accounting numbers. And accounting numbers could be manipulated. So it's always important to do accounting analysis before you start ratio analysis. Okay? And we also try to use standardized format of financial statements. So again, before you compare Qantas numbers with Virgin's numbers, okay, remember they have different formats to report these numbers. Okay? And we use standardized format to do this comparison to make sure the operating profit is the same operating profit in the two companies. Your depreciation policy is also similar across the two different companies. Okay? So those comparisons will be more reasonable. All right? Before we move on, any question here? Okay. Now let's go to the ratios. Those are nothing new. You have learned them before. So broadly speaking, we have 4 or 5 types of ratios. The first one is called profitability ratios. They measure company's profitability, okay, or we call operating management measures. As we discussed, okay, the reason why company or business operate is to make profits. The more profit you can make, we think you are better. Okay? So we capture that by profitability ratios. Second one is term ratios. We use to capture company's investment management. Now in this case, for company, their investments is not in share markets, bonds markets. Their investments are in their own assets. Okay? You want to make sure you have enough assets in place, but not too much. Okay? So we want to examine how efficient you are using your assets. The idea here is if you can use a little bit of assets to produce a lot of sales or revenue, that's good. Okay? If you have a lot of assets but only bring a little bit of revenue, that's bad. Okay? Next one is financing decisions. Okay? So we want to capture your financial risk of liquidity and the leverage. Do you have too much or too little financial risk? Then dividend policy, examine about payout ratios. At the end of the year after your operation, you have, say, this amount of profits. You may want to give some money back to shareholders as dividends, okay? Because some investors demand cash from the company as dividends. But you don't want to pay out too much. If you pay out too much, you may be left with too little to support your operation next year. You may be forced into raising capital in the capital markets. That will be costly. So for company, you have to balance the benefits and cost of these dividends to make the right decisions. There are also some ratios commonly used for valuation purpose, like P ratio, PB ratio, or dividend yield. Okay, we'll discuss more of this next week when we talk about valuation. All right? So first, profitability ratios. For most of the company, or in many cases, we use profit margins to measure company's profitability. Now, for profit margins, typically, it's your profit divided by your sales. So sales is always the denominator. You have a gross profit, which is the gross profit margin, which is gross profit divided by sales. This is net profit margin divided by net profit divided by sales. You have no PAT margin. This is net operating profit after tax. Okay? And that captures your after-tax operating profit. You have an EBITDA margin. That is earning before interest, tax, depreciation, amortization divided by sales. EBITDA captures company's profits more or less on cash basis. we exclude those depreciation and amortization because those are not real cash outflows. Those are accruals or accounting adjustments. Okay. Now, all this profit margin tells you one thing. That is, from every $1 of sales, how much money you can keep as your profit, whether it's net profit or gross profit or operating profit. Now, the higher the profit margin, that means from every $1 of sales, you can get more profit. We think that is good. Okay? You are making more profits for your shareholders rather than get washed out by expenses. Okay? One simple way to get this ratio is something called common size income statements. Now, what is common size income statements? Remember, when you look at the income statements, you start with sales minus cost of goods sold, you get gross profit. Then minus those operating expenses such as salaries, employees, compensation, fuel costs for Qantas, marketing, and the other expenses, you get operating profit. Okay? Then minus other expenses, you get profit before tax. Then you pay tax, then you get net profit. So this is a simple format of income statements. If you divide every number on these income statements by sales, times 100%, that is called common size income statements. Okay? Dividing every number by sales will express every number in that income statement as a percentage of sales. Okay? So the gross profit divided by sales will give you the gross profit margin. Net profit divided by sales will give you the net profit margin. And also all the expenses will now become a percentage of sales. Okay? So you can say which expenses accounts for most of the sales. Okay? And if you want to cut down costs, you probably have to work more on those large expenses items. Okay? So this is the common size income statement. We'll give you an example later on. Now here is some example. Okay, a simple example to look at this analysis. So we have three companies, Acer, Lenovo, and Toshiba. They are all the manufacturers of computers or laptops. And we have the ratios in those 5 years, from 2005 to 2009. We have gross profit margin and net profit margin. Okay. Now look at the number for 1 or 2 minutes and tell me what you can learn by looking at these numbers. All right, so remember 3 steps in ratio analysis. Step 1, calculation. That has been done. Step 2, interpretation. So here I have 2 ratios, gross profit margin, net profit margin. And you understand what this ratio tells you. It tells you something about a company's profitability. It measures from every $1 of sales, how much money company can keep as a gross profit or net profit. Step 3, analysis or comparison. And here we have 3 companies, we have 5 years data. So you can do both time series comparison and cross-sectional comparison. Most of us like to start with cross-sectional. So which company is more profitable than others? That depends on which year you look at, right? Okay. So if you just look at the first few years, first 3 years, and very quickly what you see here is Toshiba give you the highest gross profit margin, okay, followed by Lenovo and Acer. But if you look at the net profit margin, it turns out Acer give you the highest net profit margin, okay, and the other 2, especially Toshiba, have not done very well. Okay. Now, question is why this happens? Now, first question, why Toshiba give you high gross profit margin? among than other two companies. What could be the reason for that? Okay, so from every $1 of sales, Toshiba could keep more than 25 cents as profit, gross profit. So the cost of goods sold only accounts for 75%. And this is very, very low, about 10 cents. What's the reason for that? Okay. One simple reason could be corporate strategy. They could have different strategy. So the strategy for Toshiba would be some kind of a differentiation. They want to differentiate. They want to argue we have better quality, okay? We have a good brand name, so consumer have to pay more, we call price premium, above the cost. Okay? Acer is more of a cost leadership strategy follower. They push down the cost, so they can offer low price. Okay? So they charge you low premium. Okay? So that's why they get the gross profit margin is low. Then if you look at net profit margin, actually Acer has done very well here. Okay? Because in cost leadership strategy, when you push down your cost, you also not just push down your production cost, you also push down all the marketing cost, R&D cost, all the other distribution costs as well. So your operating cost is also low. Okay? But for Toshiba, okay, even though you could have high gross profit, but your operating cost could be too high. You spend too much money on marketing, on R&D, on salaries, okay, and that could take away your net profit. So in the end, okay, you actually have low net profit, okay, especially in the last 2 years. Okay. So what we see here is could have different strategy. Differentiation could give you high gross profit margin, but not guarantee you get high net profit margin. Because for differentiation, you also could incur other expenses. Okay. And if you go for cost leadership strategy, although your gross profit margin could be lower, but if you can successfully push down cost, operating cost in particular, you could still end up with a higher net profit margin. Okay. Now after that, if you look at the time series analysis, and what you see here. In that 5-year time period, okay, what you see is the Acer's performance or profit margin are very stable, don't change much. Okay. Now Toshiba, the ratios are kind of going down, okay, especially in the year of 2008. That's the year of financial crisis. Because of economic recession for that year. Okay. Lenovo's performance is similar to Toshiba. Okay. Profit margin kind of going down in the last 2 years, and it become negative in 2008. Okay. So if you go for differentiation strategy, and you try to build up your brand name, okay, in good times you're okay. In bad times, okay, you get hit most. Okay. Typically if you go for cost leadership strategy, we have a low cost strategy like the Acer, then your performance can be less affected by economic situations. Even though okay, we still see a kind of decline in those 2 years, but still positive. At least they're still positive. Okay. So that is the kind of analysis we're trying to understand. Even though we don't know too much about the two companies, but we know they have slightly different strategy, and some variations or differences in the ratios could be determined by or driven by the cross companies differentiation strategy versus cost leadership strategy. And some time series variations could be driven by economic performance or economic situations in those years. Okay. So we can think out those kind of factors. Why is that important? Suppose you want to forecast the profit margin or sales or earnings in the next few years. Okay. Now in this case, you probably have found Acer's revenue and profits will be easier to forecast because they're very stable. You can kind of extrapolate this trend will continue in the next 1 or 2 years. Okay. But for Toshiba and Lenovo, the future could be very uncertain. And that could be largely driven by GDP growth rate, economic situations. So to make forecast for Toshiba and Lenovo, you probably have to forecast how the economic growth or GDP growth will look like in the next 1 or 2 years. Okay. That analysis help you to understand what drives your ratios. Okay. So that is what we get from the simple example here. Any questions? Okay. So that is the first example. This example is a common-sized income statement. Okay. So every number here has been divided by sales, or expressed as a percentage of our sales. So total revenue here in the middle is just 100%. On top, you break down this revenue into 4 segments. Okay. In the bottom, you look at those different expenses as a percentage of revenue. Then you get EBITDA, you get EBIT, earning before interest tax, you get interest expense, you get income expense, then net income. Okay. And you do this for 2 years. Okay. What you can say is your net profit margin actually it decreased from 27% to 26%. Then you can examine what caused that decrease. Okay. So by examining numbers, what you find is the salary actually increased a lot, from 15% of revenue to 25% of revenue. Okay. So this can help you to understand why your net profit margin decreased. Okay. So that is the benefits of having this common-sized income statement. All right, you can do this using a spreadsheet in Excel in just 1 or 2 minutes. You get a lot of insight. Okay. Rather than focus on those big numbers, millions or billions, this is more intuitive and transparent. All right, any question here? Then ROE. Now spend a bit more time to talk about ROE here. Okay. We know profit margin very well, but this ROE probably is new. So this is net income divided by equity. Sometimes it's called accounting rate of return to shareholders. The idea is equity is provided by shareholders at the beginning of the year. In the end of the year, after your operation, the company returns net income to shareholders. Or in theory, net income is all available to shareholders. So that gives you kind of rate of return, or ideal rate of return. Now, first to note is this is very different from cost of equity, okay? Or we call discount rate for equity. Okay? In your finance textbook, that is the discount rate you use to discount dividends or other free cash flow to shareholders. The simple difference here is the cost of equity is based on company's risk. The higher the risk, the higher the cost of equity. And that cost of equity must be positive. Okay? It cannot be negative. Okay? Because given risk level, for shareholder will require to have some positive returns. Okay? Negative return only happens when you buy insurance. Okay? So when you buy insurance, you are used to hedge your risk. Buy this instrument to hedge, that's why you pay a price. But when you invest your money in a company to buy some assets, you expect some positive returns from there. If that expected return is negative, that means you are expecting to lose money. If that happens, you will never invest in that kind of company or that kind of projects. So cost of equity must be positive. Okay? But ROE could be positive, could be negative, right? Okay? That depends on your net income. If you're making a profit, your ROE is positive. If you're making a loss, your ROE could be negative. So that's the key difference. Now, in the long run, or in a very long run, 20 years or 30 years' time, you will find average ROE. Now, it's very similar to average cost of equity. That's about 10%, okay, in the market. Okay. Now, in next week, we're going to show you ROE is very important because ROE is positive related to share price or share valuation. We have this equation next week. So V is value or share price. Okay. B is book value of equity. ROE is given here. Minus R, this small r is cost of equity based on company risk. We have high risk, you're going to have higher discount rate or higher R here. And the denominator is R minus G. Okay. G is a growth rate in your equity. And what you see here is that holding all the other variable constant, if you have higher ROE, your valuation will be higher. Okay. So that's the reason why when companies report high earnings, okay, or when the earnings are higher than expected, okay, the ROE will be higher, they get a high share price increase. Okay. So this equation can help us understand why or how investor or share price respond to earnings news. Okay. When you have a positive earnings surprise, earnings getting higher, you get a high share price. Okay. The reason is this. When you have high earnings, you have high ROE. And high ROE will give you higher valuation and share price. Now, ROE tend to be mean reverting. What I mean is we have very high ROE this year. In the next few years, your ROE tend to come back to the average level, or industry average level. It's very difficult to maintain very high ROE for long time periods. The reason is, number one, competition. Remember, ROE measures profitability. If you have high ROE, that means this industry, this product is very profitable. What's going to happen is that will just attract more competition from competitors. And competition will drive down your profit margin, drive down your ROE. Okay? So that is what we get from the history. Now, to understand ROE more, we look at this two-point model or two-point equation. So ROE can be decomposed into three components. The first one, net income divided by sales, times sales divided by total assets, then times total assets divided by equity. Because they're all multiplicated to each other, so you can cancel out sales. You can also cancel out total assets. What's left in net income to equity? That's ROE. But by this decomposition, we can say the first component, the first ratio here is your net profit margin. The second one is called total asset turnover ratio. The third one is called leverage. We call it leverage here. Okay? Now, if you combine the first two together, you cancel out sales, you get net income divided by total assets. That is called ROA, return on assets. Okay? Now, as we said just now, we have high ROE, you get a high share price, high firm value. So for both managers and shareholders, you look for companies that can produce high ROE in the future. Now, what kind of company will give you high ROE? If you look at this two-point equation, it will tell you a company with a high net profit margin, high turnover ratio, and also high leverage will give you high ROE. Okay? And that is what a company needs to do. So for companies that want to increase share price to maximize shareholder value, what you should do is to maximize your profit margin. Make sure you get a high profit margin. Okay? From every $1 of sales, you get more as a profit. Number two is increase your turnover ratio. In the next few slides, we're going to show you we use this ratio to measure company's investment efficiency or operating efficiency. You want to sell faster. You want to make the best use or more efficient use of assets. Okay? So that can give you a high turnover ratio. And you have to use some leverage. Okay? Now, here are two questions. Can we significantly increase profit margin and asset turnover ratio at the same time? Okay? Can we just increase profit margin and the turnover ratio at the same time? Number two is, can we always get a high leverage ratio, okay, to increase your ROE? Now, second question is easier to answer. Okay? The answer probably is no. Okay? Intuitively, when you increase your leverage ratio, you are increasing your financial risk. That's something we don't like. Okay? And we have high financial risk, your discount rate could increase. Okay? And then your price actually could fall rather than rise. Secondly, high leverage ratio means you have a lot of debt. When you have a lot of debt, you pay more interest expenses. And when you have more interest expenses, your net income will be lower. Okay? So that would negatively affect your net income and then your ROE. How about the first question? Well, it's possible, but it's hard. Okay? We observe some kind of trade-off between profit margin and turnover ratios. In some industries, in some companies, you observe high profit margin, but low turnover ratio. In other industries, you see high turnover ratio, but low profit margin. Okay? So if you look at capital-intensive industries, like mining, okay, they have a high profit margin, low turnover ratio. High profit margin could be because in those industries, competition is relatively weak. When you have capital-intensive industries, that means you have to invest a lot of capital to set up your operation. So the barrier to enter is high. Then you don't have too many companies in that kind of industry competition could be relatively weaker, so you can have high profit margin. But we have a lot of assets in place, that your asset turn ratio, sales divided by assets, would be slow, would be small. Okay, so you have low turn ratio. And if you look at the discount retailers, such as Coles or Woolworths, those kind of company has low profit margin but high turn ratios. The margin could be 4 or 5%, but they can sell very fast. Okay? They can turn around their inventory, their assets at a very high speed. Okay? Now, this strategy we'll just talk about. Differentiation strategy usually have high profit margin, low turn ratios, and the cost leadership strategy usually have low margin and high turn ratios. Okay? So that's a trade-off. This is the figure we draw. So you just plot every industry into this figure based on the asset turn ratio and the profit margins. And what you see here is this kind of a negative relationship between these two ratios. Some industries on this extreme, like grocery stores, like Coles and Woolworths, the wholesale grocers, okay, they have a high turn rate, very high turn ratio, could be 8 or 9, but the profit margin is low, at less than 5%. On this extreme, you see the healthcare, hospitals, petrol pipelines, those industries have a high profit margin, about 38, 37%, but very low turn ratio, okay, less than 1. Okay, so this kind of negative relationship here. Okay, it's very difficult to get both. Okay, but there are some companies that can choose both. One example is Apple. Okay. Now, if you look at Apple's profit margin, it's very high, 30 to 40%. Okay. But look at turn ratio, it's also very high. What happened here is now Apple has a differentiation strategy, so they charge a high price premium. That explains, and the strategy is very successful, that explains the high profit margin. At the same time, even though Apple sells computers and those electronic products, they don't manufacture those products themselves. They outsource to those ODM in China or other part of the world. So they don't have those factories, those machines to do the manufacturing. Okay? And because there's a bargaining power over those ODMs, they can get a very low price. And their asset base is light. Okay? They don't have too many fixed assets in the headquarters. They just have people doing design, doing marketing, and the management. Okay? So in that case, they get very little assets in place. The turn ratio is also very high. But we don't have many companies like Apple in this world. Okay? Apple is very successful, and therefore, because of this high profit margin and high turn ratios, ROE is also very high. And that makes Apple one of the largest companies in the world. At one point, it was the largest one, okay, in the world. Okay? But it's hard. Most of companies, most of industry have this trade-off between profit margin and turn ratios. All right? Now, further, we'll talk about the leverage. Okay? So leverage could help you to get a high profit margin, but that's a condition. To understand the condition, we can do this decomposition. Okay? We can isolate operating performance from financing activities in the ROE. So ROE can further decompose into two parts. First one is operating ROA. That measures your operating profitability from your operations, how much money you can make as profit. Second part is called the leverage gain. That is the effect coming from user leverage. So that again has two parts. The first one is the spread, which is the difference between your operating ROA and the effective after-tax interest rate. Okay? That is your interest rate, interest cost of debt or cost of borrowing after you think about the tax savings. Okay? Then second part is effective after-tax interest rate. So this gives you called spread. Then it's net financial leverage. Net financial leverage is the net debt divided by equity. And net debt is your short-term debt plus long-term debt minus cash. Okay? Now, why I want to do this? This decomposition tells you ROE is driven by first operating ROA. If your operation is very profitable or more profitable, your ROE will be higher, independent of using your leverage. Second part, your leverage. But whether leverage will give you high or low ROE depends on the spread, because spread could be positive or negative. And spread basically is your operating ROA minus your cost of debt, or after-tax cost of debt. If this is positive, then using leverage will give you higher ROE. But if your spread is negative, if you use leverage, then the second component will be even more negative. Your ROE could be lower. Okay. Now, to understand that, we need to understand when using debt, okay, you are increasing leverage. The idea of leverage is you are going to make any gain or loss from your operation bigger. Okay? And if you are making a gain, okay, if you are very profitable from your operation, then using leverage will make that gain even bigger. But if you are making a loss in your investments, using leverage will also magnify that amount of loss. Okay? Now, to understand this, let me just give you a very simple numerical example to show this. Okay, hope you can see this. Okay, so suppose today you start with $100 from your own pocket. That's your equity. Okay, and you want to buy a machine to operate. Okay, and this machine also costs $100. So you just buy one machine. Okay. You operate. You buy one machine, and this machine will give you a return of, say, 10%. Your ROA. Okay. Now, at the end of the year, you get earning, which is $10. So $100 equity equals also assets by this machine. Okay, by the machine, by operation, you get 10% return. So in the end of the year, you get $10 profit. If you calculate ROE, ROE is also 10%, because in this case, there's no debt. Okay, all the $100 assets is financed with equity. So that's a base case. Now consider borrowing. Okay, you're not happy with this $20 profits. You want to double your operations. Okay, so you borrow money. You borrow another $100. Now, whenever you borrow money, there's a cost of debt. Okay, so we assume here your cost of debt is 5% per year. Okay. Now, with this $100, you can buy another machine, right? Now you have two machines. One is financed with equity, your own money. The other one is financed with this debt. I have $200, two machines to operate, times ROE of 10%. By the end of the year, you have a $20 profit. Okay, you have two machines to operate. In the end of the year, you make $20. But remember, you borrow money, so you have to pay interest expense. Interest expense is $100 times 5%. That's $5. So in the end of it, you get $15 as net profit. Now compare this with a base case. You make $5 more profits. The reason why your bet, also ROE is also higher, because your equity is still $100. So your ROE in this case will be 15%, higher than the base case. The reason why that happens is your cost of debt is lower than your ROA. Your cost of debt is 5%. Your ROA is 10%. Okay? So your spread in this calculation will be positive. Or don't consider tax in this case. Okay? So when your spread is positive, and then if you use leverage, you get higher ROE. Now suppose that's not the case. You borrow money, okay? Same amount of money, $100, but your cost of debt now increased to 15% rather than 10%. What's going to happen? Okay, your net profit will be $20 from the operation minus interest expense, which is 100 times 15, it's $15. And your net profit now dropped to $5. And also your ROE is $5 times divided by 100 is 5%. It's lower than the base case. Why it's lower? That's because your spread now is negative. Your ROA 10% is lower than your cost of debt, okay, 15%. Okay. So whether borrowing money or using leverage can give you higher or lower return depends on your spread, or depends on the difference between your ROA and your cost of debt. Okay. If the cost of debt is low, then it makes sense for you to borrow more to invest and get high returns. If the cost of debt is higher than your ROA, it doesn't make sense for you to do that. Okay? So that's a simple idea you get from here. Okay? Now, why is it relevant? Again, a few years later, we invest in share markets. You may face some salespeople from the banks or from brokerage house trying to convince you to use margin loans to invest in share markets. What these margin loans allows you to do is you can actually get a loan from this brokerage house, like $10,000, and use the amount of money to buy the shares to invest. Okay? And for this amount of money, you cannot take it out from your account. Okay? We sell your shares, okay, will be held as a collateral. Remember, that is margin loan, and that is the same idea here, leveraged investments. You're borrowing $10,000, the amount of money from someone else to invest. To make a positive return, you have to make sure your investment return, like ROA, is higher than cost of borrowing. For average margin loan nowadays, it's 10% per year, okay? Which is not low because you compare with a home loan. Okay? Home loan average about 4% a year. Okay? So if you use margin loans and make sure your investment return from share markets must be higher than this 10% margin loan rate. Otherwise, you're going to make a loss. Okay? Now, in the share markets, price could change very quickly. If you use margin loans, okay, it also depends on your margin. Okay? If your net equity value or net value of your share portfolio is lower than a percentage like 80%, you get a margin call. If you don't meet those kind of low margin call or margin loan requirements, your lenders, in this case, the brokerage house, has the right to sell your shares in the market at that low price. That is the reason why many people use margin loans actually lose money in share markets. Okay? So be careful whenever you use leverage. You have to make sure your return from your investments is higher than your cost of debt. Okay? And that is also, in Australia, a lot of people like to invest in real estate market or housing market. One reason is, and that has proved very profitable in past about 20 or 30 years. One reason is, if you look at this calculation, the cost of debt for mortgage loans usually is low. Okay? Now, nowadays, for past 1 or 2 years, have been 4%. Okay? Historically, it's about 5 or 6% on average. But the return from housing market on average in Australia is about 10% a year. Okay? So we have 10% return, ROA, and then you get a mortgage loan at a cost of about 4, 5, 6%. That's why your return in leverage will be much higher. And in particular, in the mortgage loan, you get a we call leverage ratio about 80%. You can borrow up to 80% of housing value to make these investments. So a lot of our real estate investors were better off in past 2 decades in Australia. So that's the idea behind why they get so rich, okay, by investing in housing market. Now going forward, can you still do the same? I don't know. Okay. Those market return could change, even the cost of borrowing still remain low. Okay. But this market is getting more and more unaffordable for young people like you guys, okay, in particular in large cities like Sydney and Melbourne. All right, any question here? So that's the idea of a leverage. It has both negative and positive effect on your ROE. So this table shows the average ROE, okay, in the past 50 years in the US. It's about 10%, okay, which is easy to remember. Term ratios. Okay. Term ratios measures companies' investment management efficiency, how efficiently a company can use its assets. Okay. As was said, the idea here is if you can use a little bit of assets to produce a lot of sales, then you are more efficient. So in these calculations, the numerator usually is sales or revenue. Denominator are different kind of assets. Okay. So you can have working capital or management term ratios. Okay. You can use operating working capital, so you should get a working capital here. Okay. You have inventory term ratio, you have a receivable term ratio, payable term ratios. You have long-term asset term ratios. Okay. There's a PPE term, for example. So the numerator is always sales. Denominator are those different assets. And for these working capital ratios, Okay, you can cover days inventory, days receivable, and days payable. So first, get the tail ratios like inventory. Okay. Use the sales divided by inventory. Okay. Suppose that ratio is 5. Then use the number of days in a year, usually 360 or 365, divided by 5, you get days inventory. Why we use days? Because that gives you a very simple and intuitive measure to say, for example, days inventory captures how many days it takes for the company to sell the inventory. Now, the longer the days in sales inventory, that means it takes more time for the sell inventory. Okay. Also, days receivable captures how many days it takes for company to collect the account receivables, and how many days it takes for company to pay the account payables. Okay. So this gives you a simple idea of, in terms of number of days, how big is your inventory, or how efficient is your inventory and working capital management. Okay. So that is what I learned before. Now, low turnover ratio usually implies inefficiency. But on the other hand, very high turnover ratios could also indicate over turnover or insufficient assets in place. Okay. So what I mean is, if you just have too little assets, okay, you could have high turnover ratio, but you may lose some of the sales. One example, inventory. Okay. You should have enough inventory to support sales. If you don't have enough inventory, you could lose your sales. Now, one example again is my personal experience. So about 12 years ago, when I came to Australia, I wanted to buy an LCD TV. So I went to one of the retailers, and they found something I like. I placed an order, and they said, okay, we will deliver in 1 week. I waited for a week, nothing happened. I called them and said, sorry, we're out of stock. Can you please wait for another week? They just waited for another week. Again, they failed to deliver. So what I did is I canceled my order, went to another retailer, and bought another one. So in this case, if you don't have inventory in place, you could lose customers, you could lose sales. So extremely high turnover ratios may not be desirable. Okay? You must have a reasonably good turnover ratios. Industry average in this case could be a good benchmark. Okay? So what's the average industry? You could be slightly higher than industry average, but not too high. Okay? Liquidity and leverage ratios. So leverage could be good, could give you high ROE if spread is positive. Leverage also could help you to reduce the tax, okay? Because when you borrow money from the banks, you pay interest expense before the tax. Interest expense can make your profit before tax smaller. Okay? Then you pay less tax. So there's a bit of a tax savings by using leverage, or in particular bank loans. Okay? At the same time, financial leverage could also increase the financial risk for the company. If you could not make interest payments on time, you could be forced into bankruptcy. And that's what companies don't want to see. Okay? So companies need to balance the benefits and cost of using debt and find what we call the optimal capital structure or optimal debt level on the balance sheet. So your ratios assess your financial risk. Now, the financial risk has two components. Number one is the liquidity risk. Do you have ability to pay your creditors in the short run? Okay? Like your suppliers, okay? Or your short-term bank loans. Okay? So we use the current liability as a denominator, and the numerator are the current assets that gives you the current ratio. You can use cash plus receivable as the numerator that gives you quick ratio. And the cash ratio basically is cash divided by current liabilities. And you can use operating cash flows divided by current liabilities to get this ratio. The higher these liquidity ratios, suggest you have more current assets, more cash, more inventory, more operating cash flow to cover your short-term liabilities or short-term debt. Okay? That means you have less financial risk. On the other hand, if these ratios are low, you could have high financial risk. You could have difficulty in paying your short-term creditors. Now you also have long-term creditors too. Okay? So we can examine these debt ratios, debt to equity, debt to net capital, debt to assets. Okay? Now you can also look at, now when you have high debt ratio, that does mean you have lot of more liabilities. Okay? But to capture company's ability to pay the debt, we typically examine the coverage ratios, like interest coverage ratio or cash flow coverage ratios. Those coverage ratio captures, do you have enough earnings or cash flows to pay your interest expense? The high coverage ratio means you have more cash flow, more earnings relative to interest expense, then making payments on time is not a big problem. Then you have a low financial risk. Those calculate interest cover ratio, you use net income plus interest expense. We have added back interest expense. Okay? Then divide that sum by interest expense. That measures, okay, relative to your interest expense, how much earning do you have. This one is cash flow from operations divided by interest expense. The larger this ratio, coverage ratios, you have a better ability to pay your interest expense. They have lower financial risk. Now, in this calculation, it's always important to make adjustments for off-balance sheet liabilities such as operating lease. Last week, we discussed how we can convert operating lease into capital lease. Okay. One main reason for the comparison or conversion is to give you a more realistic, more reasonable measures of company financial risk. Because this operating lease also represents compulsory cash outflows in the future. That's just like bank loans. Company has to make this cash outflows to make sure they could survive in this business. Okay. So those are just like liabilities. We make that conversion to increase your liability, your debt, increase your interest expense to give you the reasonable assessment of financial risk. Another simple one that I like is this Z-score. Okay, this is kind of a magic number in the financial risk assessment. Okay, it's very simple. Okay. It was developed by Altman in 1968, about half a century ago, okay, based on the measure, a simple measure of financial risk. Okay. So this score calculation is very simple. It's 1.2 times current assets minus current liability divided by total assets. And this is sometimes what we call working capital divided by total assets. Then plus 1.4 times retained earnings divided by total assets. 3.3 times EBIT, earning before interest and tax, divided by total assets. And 0.6 times market value of stock divided by book value of a liability. And 1 times sale divided by total assets. So all these numbers are the financial ratios. Okay. You can obtain easily from the financial statements. Those coefficients, okay, are obtained from the historical data after running regressions. Okay. And you can do the simple calculation. And decision making is very easy. If this score is higher than 2.67, there's no risk of bankruptcy. Company is in a safe and sound position. If this score is lower than 1.81, company has a very high bankruptcy risk. If this score is between these two numbers, it's called gray area. Okay? You have some risk of bankruptcy, but not that urgent. Okay? You probably should put that into a watch list. So you can do this calculation in 5 or 6 minutes. You get a very good indicator of company's financial risk. And to say this, we're going to show you some examples as well. Now that model asks you to get this market value of a stock. Now sometimes we want to do the same calculation or same assessment for private companies. Now actually in the market, private companies are more likely to go bankrupt than public companies. So private model would be more useful. Now, private companies don't have market share, market price, or market value of stock. So we have to use book value of equity based on the balance sheet. And then you reduce the estimation, you get a new set of coefficients. Also slightly different, the decision rules. If you use private book value of equity model, if this goes 2.9, there's no risk of bankruptcy. If this goes lower than 1.23, you have high risk of bankruptcy. Now, to say how it works, we computed this score for Kodak. This company was actually one of the largest one in the world in past century. Okay? Now, its main product was those camera films. If you take those cameras or take a picture at least 20 years ago, you need to insert a raw film into camera and take a picture. And this is the largest player in that market. Again, no, I'm not sure if you remember, in 1980s, 1990s, if you go to any part of the world, it's a lot of those stores under this Kodak sign, especially in those tourist cities. Okay. What happened is starting from the start of the century, now people moved from this film camera to digital cameras. So demand for film basically goes down day by day. And for some reason, this company was a bit strange. Okay? They did not catch up with the change in consumers' demand. There are some reports saying actually back in early 1990s, Kodak was the first one in the world to develop the first digital camera in the world. But the company was afraid that if we just produce the digital cameras, the demand for film, the main business, would go down. So they hold that project for too long. Okay? Then in the early 2000s, okay, when every other company is producing digital cameras, this company was too slow to catch up. Okay? And then the company was basically out of business. So what you say here is we calculate this score, what you said just now, get the ratios year by year, we do this, and we plot in the graph. So the blue line is 2.67. Above this line, the company has no risk of bankruptcy. The red one is 1.67. Below this line, company has very high risk of bankruptcy. And what you see here is from 2001 to 2010, company this score is between these two lines. That is what we call gray area. You have a certain risk of bankruptcy, okay, but not that impressive. Then in 2001, company this score is 1.5. Below the red line, you have very high risk of bankruptcy. 2012, even lower. And in 2012, shortly after the reporting financial statements, they filed for bankruptcy. Okay. So even though this model was developed 50 years ago, but it can still apply to a company nowadays and get a very good indicator for its financial risk. Again, this calculation is simple and easy. Take just a few minutes. You get one of the best indicators, okay, for this score. And this model has widely used in the industry, even by those professional credit analysts in the banks, in rating agencies. So it's very simple to use, easy to apply. All right? Another example is OneTel. This is an Australian company. Okay. Again, I'm not sure if you remember. Okay. This Australian-based telecommunication company started operation in 1995. Okay. Okay. 2 years later, in 1997, company went to IPO. Another issue price, $2 per share, market cap $200 million, a small cap company. Another 2 years later, company make it to the one of the 30 largest company in Australia. Okay, market cap $6.5 billion. Now think about that. It started from scratch in 95. In 2 years, it went to IPO. In another 2 years, it became one of the 30 largest company in Australia. That's success, right? That's a dream for many young people. But it collapsed in 2000. So 5-year history. That's really maybe you probably have no idea what this company is. Okay, if you ask your parents, in those days, OneTel's advertisements basically is everywhere. Like what you see nowadays, like TPG or those Doodoo. It's everywhere. Okay, 20 years ago, it's OneTel, okay, playing this role. Okay. Now the question is, can we use this score model to predict bankruptcy? Okay, you can start with the book value model. Okay. So those are the coefficients. Use the book value equity model. Those are ratios from company's financial statements. Those are products. Add them up, you get this score. Now in 1999, this score 2.067. That is in the gray area. Okay. A year later, this score is only 0.6. Right. That's far below 1.23. Indicating company has very high risk of bankruptcy. Actually, again, just 1 or 2 months after the financial statements was announced, company filed for bankruptcy. Okay, so this model again worked very well in this case for OneTel. Now we want to ask, why do you use book value equity model? This is a public company with a share price. Why don't you use the market valuation model? Okay, let's take a look. Now for year 2000, if you use the book value equity model, you get this score of 0.6. That's what we saw in previous slides. If you use the market value model, this score actually is 3.365, which is higher than 2.67, indicating there's no risk of bankruptcy. Okay, so in this case, the market value model gives you wrong predictions, and the book value equity model gives you right predictions. Now we want to ask why. Why don't they tell you a consistent conclusion? Now, if you take a look at those components, okay, you find many of them are quite similar, except for one. Okay, that is this book value of equity divided by book value of debt, or market value of equity divided by book value of debt. Okay? Now this ratio, if you use the book value of equity, is 1.98. If you use market value of equity, that's about 6. And because of the 6 times coefficient 6, you can still put 6 here. In other words, the z-score from market value model, 0.365, all comes from just one ratio. That is this number here. Okay. And all the other numbers are small or even negative. Okay. Now what happened here, you could argue, is in the year of 2000, that's a year we have an internet bubble around the world, including Australia. So even though OneTel is a telecommunication company, so it's quite close to the internet, you get a very high valuation. The share price has been pushed up too far, too much. So its market value of equity was too high relative to its book value of debt. Then you get a very high ratio here. And this ratio, or the misvaluation of shares, distort the z-score. Okay? And for that reason, you don't get a good predictor or good prediction of bankruptcy. And that is also the case for all the technology companies in that time period. If you use book value model, almost all the technology companies have very high bankruptcy risk. But if you use market value model, that risk is very small. Okay? Now, what happened is just 1 year later, in 2001, when this internet bubble bursted, a lot of those technology companies bankrupted. Okay? So the high valuation or the misvaluation in the share market, okay, could give you a distorted prediction if you use market value model. The lesson we get here is it's always a good idea to check with this book value model. Again, calculation is simple and easy. You get most of these ratios. You have to calculate just one more ratio. And then plug into equation, do a calculation again. You get another good indicator of a company's bankruptcy. Okay? So that's the z-score model. Simple and easy, strong recommend for you to use. Okay? All right, so summary ratios we'll talk about next week. Now let's take a break of 10 minutes. Then we'll look at this example. All right, let's come back to the class. So just now we talk about those ratios. Okay. They are not new to many of you. Okay. Now remember the 3 steps in ratio analysis. Okay. Calculation, interpretation, and analysis. Most of you have learned those ratios before, and you understand how the ratio can be calculated. You need a formula, how that could be interpreted. Okay. Next is analysis. Now what we'll do next is we look at this example, and we can show you how a probability analysis can be done. Here we have 2 companies, Walmart and Target. Now Walmart was the world #1 retailer, big, okay, huge. In 2005, its sales was $312.4 billion, net income $11.2 billion. Now those numbers are huge. Okay. In some countries, the total GDP is less than $300 billion. Okay. Its slogan was everyday low price. So just like Kmart or Kohl's, they try to push down the cost. They can offer low price. So strategy is cost leadership strategy. When you have low price, they only can survive if you have low cost. It also trying to expand into international markets, setting up stores in China, Asia, or Europe. Okay. For some reason, they did not enter Australia. Okay. So that is Walmart. Target was the 2nd largest retailer in the world, in the US as well. Okay. In 2005, its sales was $52.6 billion, net income $2.6 billion. Now compare those numbers with Walmart's numbers, you can say Target is much smaller. Okay. As we said just now, you want to find a benchmark that has comparable size. Now in this case, Walmart was about 6 times as big as Target. Are they comparable? I think this is the best you could find in the market. It's the 2nd largest one in the market. You find anything else that can even be smaller. Okay. So that's what we call the best available. When you do analysis, just bear in mind they are different in the size, and that difference could affect some ratios. Walmart's slogan was Target's slogan was expect more and pay less. Pay less means they also focus on price. They try to offer low price, okay, to compete. At the same time, they ask you to expect more. Okay. That means they try to differentiate a little bit. Okay. So they ask you to maybe, they offer you better quality products, better designs, so you can pay a bit more for the products. Okay. So they focus more on the design to attract affluent guests, or they call the customers guests. That's a way to think about their attitude. Now compare these 2. We say that have difference in the size. They also have a bit of difference in the strategy. Okay. Now, if you want to think about some real example in Australia, let's look at this. Target has operation in Australia. If you go into Peter Shopping Centre, there's a Target in level 2. Walmart is some kind of like Kmart. Okay. Offer low price. Okay. Target price is a bit higher, but also give you higher or slightly better quality products or better designs. So that's the difference. So have different strategy, slightly different products. Remember, those things could affect the ratios. Okay? So that is basic kind of background information for both companies. Now next, start with ratios, profitability. So here we report ROE, okay, and it's 3 components: net profit margin, asset turn ratios, and financial leverage. Okay, RA is reported here as well. For Walmart, we have data for 2004 and 2005. For Target, we just give you the number for 2005. Okay. So the first step is done. Calculation is done here. You are given the ratios. Next, you need to interpret and analyze those ratios. Okay. So based on these numbers, what conclusion can you draw? Now, if you finish this, you can keep going for the next few slides. There's another way to look at the components of ROE. You have operating ROA, spread, and the net financial leverage. Financial leverage, again, is a product of a spread and net financial leverage. Okay? You can move on. This is a common size income statement. Okay? Tell you those numbers on the income statements as a percentage of sales. Okay? You can move on to these term ratios and the liquidity ratios, solvency ratios. Why share this? In the exam, you could be given all this information, and you could be asked to write down the conclusions or what you learned from those numbers. If you're going to interview as a financial analyst or credit analyst, you could be given the same question as well. Okay? So given your understanding of these two companies, given this information, what can you learn from those numbers? Okay? What kind of thing you write down in your exam paper? You have 10 minutes to work on that. Okay? So try to write down on your lecture notes or any piece of paper, okay, your conclusions here. Then we're going to discuss those together. Now you can discuss with your friends sitting beside you, but please write down your answers on a piece of paper or your lecture notes. All right, let's come back. Now, many of you think this is a time for you to chat, to play with your phone, but now, trust me, you could say the same question in your final exam. Okay? So this is a real chance for you to, to practice what you learned, and also for people who are interested in a job as a financial analyst or credit analyst. I'm pretty sure when you go for interview, you'll be given some questions just like this, okay, to test if you understand the basic things. Okay? And also, if you work as an investor, these are things you're going to learn every day. Now, let's come together to work on these numbers. So given those profitability measures, what do you learn? In your exam paper, what are kind of things are going to write down? Nothing? Make it 0. Okay. So where do we start? Anyone? Come on, it's not rocket science. Okay. Which company has high ROE? Okay, Walmart, right? Okay. So what does that mean? So you need to understand what ROE tells you, right? So this is accounting rate of return from every $1 of shareholders, how much money company can return as a profit at the end of the year. And so that's the idea of that. And it's a measure of profitability. So on that account, you could argue Walmart was more profitable than Target. Okay. So that is the what we call cross-section analysis. Compare company A with company B. And you want to say which company gave you better performance. Okay. So that could be a starting point. You compare these numbers in 2005, you found ROE is higher for Walmart than for Target. And you know that it tells you Walmart was more profitable than Target. So if you write that down, you get 2 marks. Okay. But this question could have 20 or 30 marks. We need more. Okay. We need more than that. What else? Excellent. Okay. Okay, you could get 10 marks for that, what you said just now. Okay. So you move down, you want to say why ROE is higher than Walmart, for Walmart in that year. If you do components, net profit margin actually 3.6 for Walmart and 4.6 for Target. Okay. So remember again, what does the profit margin tells you? It means from every $1 of sales, Walmart can only keep 3.6 cents as profit, and Target can keep 4.6 cents as profit. Okay. So in that sense, again, you could argue, no, Target has high profit margin, more profitable. Okay. Now, you probably want to ask why. Why the net profit margin for Walmart is lower than that for Target? Now, one reason as we just discussed, could be strategy or products. Okay. So target has a bit of a differentiation strategy, offer relatively high quality products, so they charge you a bit of high price. Okay. So that is, you try to speculate or find some possible reasons to explain the difference. Okay. So if you just stop saying, no, A is better than B, that's not enough. Okay. For analysis, we want to understand why, even though you don't have a 100% confidence on those explanations, but you should have the ability to speculate and try to figure out why. Okay. So that's the basic job of financial analyst or investor. Now going down, you have asset-to-turn ratio, and you found Walmart's turn ratio is 2.6, target 1.6. So Walmart is much better than that. And again, why? Quickly, that could also be related to the strategy. As I said just now, there's a trade-off between profit margin and term ratio. We have high profit margin on average, you usually have lower so we have high profit margin, you have low term ratio. So here for Walmart, they have low profit margin, they could have a high term ratio. Okay, so again, could be driven by product strategy. Now here's an interesting question. To what extent, okay, your disadvantage for Walmart, your disadvantage in profit margin can be offset by your advantage in asset-to-turn ratios. Okay. So yes, we know you have a cost leadership strategy, you treat down your cost, so you can offer low price, that's why you have low profit margin. But at the same time, we know you have an advantage in term ratios. The question is to what extent your advantage can offset your disadvantage. Okay. Or you can actually do better. More than offset your advantage, you can do better. To answer that question, we look at ROA. Because ROA is a combination of a profit margin and term ratio. If you multiply these two ratios together, you get ROA. And then you find Walmart's ROA 9.3%, much better than 7.5% for Target. Okay. So this tells us, because of the strength on asset-to-turn ratio, Walmart can offset its weakness in profit margin and give you high ROA. And actually, if you know a bit more about Walmart, a key competitive advantage or key success factor for Walmart is this asset turnover ratio. Company has paid a lot of attention to asset turnover, and it has a very high efficiency in operation management, and the company has achieved a high turnover ratio, much higher than industry average and then Target. So this is a company's key strength or key success factors. Okay. Now, if you know company's management style, you probably know this fact. If you don't, by simply looking at these ratios, you can identify this probably is very important for Walmart. Now, in terms of financial leverage, no, it's quite similar. Okay, 2.48, 2.43. So again, from here you can say the difference in ROE basically is driven by the difference in ROA. Okay? The leverage is very similar. Okay? So because of this high term ratio, low profit margin, but still because of strength in term ratio, Walmart was able to give you high ROA. And this high ROA again is driven by the term ratio. So that's what we can get from this simple analysis. Okay. Compared to two companies, Walmart is more profitable, getting high ROE. The reason why ROE is higher is the term ratio, not because profit margin or leverage. Okay. So this can help you to identify company strengths or success factors. So this is cross-sectional analysis. Next, you want to examine time series analysis for Walmart. Now again, starting with ROE, this number dropped by 0.8 percentage points. Now you may argue that's just some noise or random noise in the year-from-year operations. You could argue that's important because this company has a huge amount of assets and equity. So 0.8% could mean hundreds of millions of dollars. And more importantly, you want to examine what happened, what caused that change. So again, look at the components. Profit margin is the same. Exactly the same, 3.6%. Then you find asset turnover ratio decreased from 2.73 to 2.61. Okay. Then remember just now we identified this turnover ratio is a key success factor for Walmart, and this number decreased from 2.73 to 2.61, suggesting you are not as efficient as last year, or you're not as competitive as last year. So that could be alarming for many investors. Okay, so what happened? Okay, before we look at that, then because of the drop in asset turnover ratio, you say company has low ROA. Now in terms of financial leverage, the leverage actually increased a little bit from 2.4 to 2.43. So again, by this analysis, it says the decrease in ROE basically driven by the decrease in asset turnover ratios. Okay. Now here's a question. Before you look at anything else, what could be a reason for a company's asset turnover ratio to decrease? So remember, this ratio is your sales divided by total assets. What could be a reason for a decrease in this ratio? Well, a simple answer could be holding your assets constant, your sales decreased. Okay. Now that answer doesn't work here because from 2004 to 2005, both assets and sales are growing. They're not declining. Okay, so sales are increasing, assets are increasing. Now the ratio decrease must be the case that the increase in sales is smaller than the increase in assets. Okay, that's why ratio drops. In other words, for example, your assets increase by 10%, but your sales only increase by 6% or 5%. Then the ratio will go down. Now the question again comes back to here. Why the asset increased by 10%, but your sales do not increase by the same amount or same percentage? So what's the reason for that? Suppose you're a manager of a Walmart. Okay. When you say this ratio dropped, you want to ask why. Then you have to give yourself some answers. What could be the answer for that? Now here's time for brainstorming. Okay, you don't have to be confident or be sure of your answer, but you need to list some answers so you can try to explore a bit more. So what could be the reason for that? They have too much inventory. Very good. You have too much inventory, you could not sell. Okay, so this ratio could drop. What else? Sorry, I could not hear that. Very good. You have too much investments in fixed assets like buildings. You open new stores. Okay, but your sales did not increase as much. Okay, very good. What else? Very good. If it's more competition. Okay, so given the same amount of assets, because competition, you have less revenue. Then ratio goes down. Okay. What else? Okay. Now I can think about those. Say again, those are very good points. Here, if you look at ratios, the sales divided by your assets. You can think about different assets. You can think about the sales. Okay, there could be something wrong with your assets, like your inventory. You have too much inventory which you could not sell. So inventory increase, but sales goes down, or sales don't increase that much. Okay, so you have one type of inventory. People like particular type of products, but they don't supply. You supply the wrong type of inventory, then they don't buy. Okay? So your inventory increase, but sales actually could decrease or did not increase. So that could be one reason. Okay? You could think about your accounts receivable. You have too much accounts receivable, okay? Or you have too much other type of inventories, or you can think about long-term assets. You open too many new stores, okay? And this, when you open new store, okay, there's an effect called capitalization. That is, the incremental sales from new store will be smaller than the sales from old stores. There could be several reasons for that. One is market saturation. Okay? Suppose you want to open the first store in a new city like Brisbane. Okay? Usually the first store will give you the highest, the maximum revenue because that's the first one in the city. When you open the second one, okay, you're going to choose the second best location. And also the second one will distract some of those customers or attract some customers from first store to the new store. So the incremental sales for second store usually is lower than the first store if that can keep going on. Okay? So when you open new store, then this new sales, okay, will be smaller than old stores. So your store number could increase, your asset could be doubled, but your revenue will not double. Okay? So that could be another reason. Okay? Market saturation. Competition, another one. So again, competition means given the same number of stores, but other people open new stores in that area, and they take away your sales. Okay? So that will drive down your sales growth rate, and then your lower turnover ratios. Okay? And it could be the international operation as well. Now think about the first year when you enter new markets. You invest a lot of money to open some new stores, you set up a distribution channel, your warehouse, but the revenue may come next year or in the future years. So in the first year, your asset increase a lot, but your revenue doesn't increase that much. So those are reasons for the decrease in the turnover ratios, or you think about economic recession. Okay? So that's recession. So given the same number of stores, the revenue drop. Okay? Now, we have to, for a good analyst, you need to list all those possible reasons, then try to examine one by one, think about which one is reasonable. Now here you can rule out recession because in 2005 there's no economic recession. Economic is growing reasonably well. Okay? But all the other reasons could be possible, and you want to investigate a bit more. Now why is that important? They affect your forecast. Okay? Now think about the two simple ones. Number one is competition. Because the competition is getting stronger and stronger, that's why you have lower turnover ratios in the year 2005. Now, when it comes to forecasting, you probably can expect that the competition is getting even stronger going forward. So this decrease in turnover ratio will continue. Okay? That means your ROE will keep going down in the next few years. Remember just now we said ROE is linked to your share price and share valuation. When you have low ROE in the next few years, you can forecast price probably will go down as well. So if that's due to competition, market saturation, then you're going to see more and more decrease in ROE and more decrease in share price going forward. Suppose that is due to, or the decrease here is due to the international expansion. And what we know is in the first year, you could have more assets than revenues, but going forward, your revenue will catch up. Because investments in warehouse distribution channel will be one-off. After you make those investments in the next few years, you don't have to do that again. And then revenue will gradually build up, and then your turnover ratio would reverse and increase in the future years. Everything else constant, when this ratio increase in the future years, your ROE will improve, your share price will improve. Okay? So different reasons could give you different prediction on this key success factor asset turnover ratio and the ROE and the share price. That's why we need to figure out which one is the true reason behind this decrease in ROE. So that's what we say. Ratio analysis is just a starting point. Okay? That's not the end of it. Okay? We have a list of reasons. We want to explore which one is the true reason behind that. And to do that, you need to do more analysis. Okay? Any question here? Right. The second slide. Here we decompose ROE into opening ROA, spread, and leverage. Okay. So again, if you look at the opening ROA, compared to two companies, okay, Walmart has much higher opening ROA. And remember, spread is basically the opening ROA minus the cost of our debt. Okay? Because of high opening ROA, Walmart also has a higher spread. In terms of financial leverage or net financial leverage, Walmart's net financial leverage actually is slightly lower than Target. But because of high ROA and the high spread, then the financial leverage again, 6.7% is higher than 5.1% for Target. So financial leverage again is the spread times the net financial leverage. So again, everything here in this slide between the two companies driven by this opening ROA. We have high ROA, you have high spread, that's why you have high financial leverage again, even though you have lower financial leverage. But if going back to previous slides, the reason why you have high opening ROA for Walmart is because they have a higher asset-term ratio, okay? Not because they have a high profit margin. Okay? Now again, compared to 2 years, you find this opening ROA decreased from 16.9% to 16.1%. And because of decrease, you have lower spread. Okay? Even though your leverage increased, okay, but your gain is comparable to last year. Okay? So again, this decrease in ROE is driven by the decrease in opening ROA. And again, linked to previous slides, the decrease in opening ROA is due to the decrease in the turnover ratios. Okay. So that is what we say from the two slides. The message is the same. All the change for Walmart, difference between the two companies, changing company for Walmart's ratios is driven by these turnover ratios. Okay. A very simple number here, but very important for Walmart. Okay. Now next, this is a common size income statement which tells you the profitability ratios or profit margins. Okay. And what you see here is the net profit margin is higher for Target than for Walmart. And almost every expenses here is for cost of goods sold. Okay. That is higher for Walmart. And but Target spend more money on SG&A expenses, that is sales, general, and administrative expenses. That include marketing expenses. So Target spend more money on that, which is consistent with the differentiation strategy. When you try to differentiate, you try to spend more money on marketing to tell people you are better, you are unique, your products deserve a high price. Okay, so that is nothing wrong here. This other expenses is also high for Target, and then they pay a bit more income tax. Okay, but the key difference here is this cost of goods sold. Okay, that is much higher than for Walmart than for Target. Okay, so for the other profitability ratios, Target always has higher profitability ratios or profit margins than Walmart, consistent with this differentiation strategy or better quality products. Okay. So next, we look at turnover ratios, and here we break down the total asset turnover ratio into different subclasses of asset turnover ratios. Something strange here. So first one is operating working capital turnover ratio. Okay. That is your working capital as the denominator, sales as the numerator. And if it's negative, and it's very big, okay. They have a net long-term asset turnover and PPE turnover. They have a accounts receivable turnover, inventory turnover, accounts payable turnover as well. Okay. And then these are the days accounts receivable, days inventory, days accounts payable, which measures how many days it takes for you to recycle those working capital accounts. Now first, okay, let's start with the easy one. Okay. This number here, accounts receivable turnover is huge, 182, 228 for Walmart. Why so big? Those are not calculation errors. There's true numbers here. Okay, so how do we calculate accounts receivable turnover? That is your sales divided by accounts receivables. For sales, for Walmart, that's about $300 billion. Okay. Now accounts receivable, how much accounts receivable you expect Walmart to have? Probably not much, right? Because when you go shopping with Walmart, how do you make payments? Cash or credit card? If you pay cash, that's no account receivable. Cash sales for Walmart. If you pay credit card, your credit card will be cleared in 2 or 3 days. Okay? So for Walmart, that's not much account receivable. Okay? That's why your sales $300 billion divided by a small number for accounts receivable, this ratio will be huge, 100 or 200. And that is also consistent with this days accounts receivable. This captures how long or how many days it takes for Walmart to collect accounts receivable. Here's about 1 or 2 days. That is consistent with the credit card payments. Okay? So this number are huge, but they're not important. Okay? Because you don't have too much accounts receivable to start with. The next one, the inventory, as just showed. One reason for you have a low turnover ratio is this inventory turnover ratio. You have too much inventory, wrong type of inventory. Now compare this year, there's a little bit of decrease in turnover ratio of inventory from 8.1% to 8.1 to 8. In terms of days inventory, that's increased from 45.1 days to 45.6 days, a half-day increase. Okay. So again, the change is very small. Okay. Probably not enough to explain the change in the total ratio. So this helps us to rule out one more explanation. Now there's a bit of a decrease in accounts payable turnover ratio, dropped from 11.1% to 10.9%. So overall, the working capital accounts, inventory, payable, receivable tend to be quite stable. Okay? So that may not be enough to explain what happened for the decrease in working capital turnover ratios. Now come to the first slide here. This number is huge. It's big because your working capital is small. Sales, the revenue, the numerator is 300 billion, but your working capital, that's your current assets minus current liabilities. That's the difference between this current asset and current liability. That number is very small. So let's get a big ratio. It's negative because your working capital is negative. Okay. For most of these retailers, like Coles and Woolworths included, they could have a negative working capital. So their current assets is not enough to cover current liabilities. But for most of these retailers, it's not a big problem, okay? Because they always get enough inventory or enough cash from the customers to make the payments for the creditors. Okay? So they don't have too much liquidity issues here. Okay? So again, this number is, so that explains the negative big number for these ratios. Okay? Now next is if you examine this net long-term asset turnover ratio, that decreased from 4.3 to 4.0. And in particular, PPE, turnover dropped from 0.9 to 4.6. So that could be more worrying because this company has a lot of stores, large number of stores, and a lot of fixed assets. Okay. So PPE ratio turnovers are dropped. That could explain the decrease in turnover ratios. But come to the question, why did PPE decrease? Or PPE turnover ratio decreased? So same story. When you open new stores, okay, company is growing. When you open another new store, the incremental sales from this new store is smaller than the average sales for the store in previous year. So that again could be due to competition in the market saturation in the US market, okay, or international expansion. In the first year, again, when you open one new store in a new market, okay, you don't have enough sales because it takes time for people to know your product, to shop with you. Now, to understand which reason explains this decrease, you want to do more analysis. For example, to decide if it's competition or market saturation in the US market, you want to examine the industry competition in that market. How many new stores are opened by Target? How many new stores are opened by other competitors? Okay. Is the market getting more saturated? Okay. So that's the competition or industry analysis you have to do before you conclude if that's due to competition. To examine whether that's due to the new markets, you want to examine Walmart's international expansion strategy. How many new stores do you open in other non-US markets, like Europe? Okay. What's your investments in Europe, and what's the revenue coming from there? Okay. So this kind of a more analysis will help you to identify what's the true reason behind the decrease in those ratios. And remember, these reasons can help you to make better predictions about the future ROE and the future share price. And that's what we said. Ratio analysis like this is just a starting point. Okay? You need more analysis to identify why ratio changes over time, why company A's ratio is better than company B's ratios. We needed those analyses to help us to make better predictions of future performance and share price. All right? Any question here? Okay. And I believe that is the most valuable insight a financial analyst and the investor could have. Okay. So remember, it's not easy, it's not enough to just do a calculation and say this ratio increased. Try to understand why. That question will help you to stand out in your interview. Okay. Will help you stand out in your job as well. Okay. So always ask a bit more questions and do more analysis. Now next, liquidity ratios. Remember, we use this ratio to assess companies' financial risk, in particular, companies' ability to pay the short-term creditors. And what you see is for Walmart, its current ratio is lower than 1. Consistent with what we said just now, company has more current liabilities than current assets, because this ratio is the current assets divided by current liabilities. A ratio less than 1 suggests you don't have enough current assets to cover all your current liabilities. But there has been under this situation for 2 years. If you look at target, it's 1.69, which is more conventional. Now, on average, okay, we expect a company to have a current ratio higher than 1. So just to have more current assets and current liabilities, okay, like something like target. Okay, that means you have enough current assets to pay short-term liabilities. But for a company like Walmart, and if you look at this Coles and Woolworths, they have the same ratios like this. Okay? And if you look at them, this ratio in the past 10 years, it's always below 1. So company has been able to operating under less current assets for many years. And it turns out that could be a success factor as well, because effectively, you're not financing your own working capital. You're using your creditors' money, that's your current liability, to finance your current assets. That could be an efficient way to run the company, as long as you can make sure you have the ability to pay the short-term debt or short-term liabilities. Okay. So these ratios are, other ratios are quite similar. Okay. So there's not much change in the liquidity ratios. They can conclude liquidity may not be a concern for Walmart. Now for solvency ratios or debt ratios, okay. So what I found is these two companies, again, in those years are quite similar in terms of debt ratio. Okay. Now, in terms of change, so Walmart has high liquidity ratio, okay, or more debt in 2005 than the year 2004. Okay. So company use more debt to finance growth. When they open new stores, much of the stores could be financed with debt, okay, rather than equity. Now, look at the last two, the interest cover ratio. As we said just now, we use this ratio to capture company's ability to pay interest expense. Okay. Higher ratio means you have more earnings, more cash flows to pay your interest expenses. For example, the number here, cash flow coverage, is about 16. That means in 2005, Walmart's operating cash flow is enough, okay, or is 16 times as big as its interest expense. If we assume in all the future years, its interest expense will be constant, then that means 2005's operating cash flow is enough for Walmart to pay interest expense for the next 16 years. Okay. Now we have that kind of a ratio. Company has plenty of cash or earnings to pay interest expense. Then the leverage risk or this financial risk is very low. Now for Target, those numbers are also looking very good, 8 times and 12 times. Okay. Its earnings are about 8 times as high as its interest expense. Its operating cash flow is about 12 times as high as its interest expense. Okay. So both companies have very little financial risk based on this coverage ratio, even though it has a substantial amount of debt. Okay. So that is what we can conclude. Now, if you have time, you can also calculate this score for both companies. Okay. You'll find they are very, very safe. Okay. This score is far above 2.67, the critical line. All right. So that is what we get from ratio analysis. Now, before you go, just remember, when you do ratio analysis, there's always 3 steps: calculation, interpretation, and the analysis. The most important and the most valuable step is step 3. After class, please read your textbook in chapter 7. Make sure you know the ratios. Okay? Also, if you have time, please find quantiles, find your statements, and do this analysis for quantiles. Okay? You'll get some useful insight. All right? So we'll stop here and see you next week.
ratios, you have to remember what we talked about in the class. Those ratios you need to remember. You need to memorize. Right.
Last week there's a lot. I read the
you have to understand accrual. Okay. So that's very important. So again, or if you need some accounting knowledge. Okay. Yeah, so again, I'm not sure how fair is the test. I guess some kind of multiple choice questions like yeah, the bulk of the assignment, so we have a next round and one more. So yeah. Or maybe six. So we'll for announcements.
So why did you see that line always be cash or credit card? So if you go target also be cash or target?
Yeah, target has a set for the conversion tools. They have customers who are customers.
Also before the target large sales is more so that means the target is lower financial risk. But the analysis is probably not true. That means the target has higher financial risk. Why? Also the coverage is good on no, I mean on the
coverage, those interest payments also for long-term debt.
also that
Interest payments are always interest-bearing long-term debt. You could have a small portion coming that's due this year, but you do have that long-term debt. And all these accounts payable here is called liability of you pay next few months, next 12 months.
yeah, that's a short term.
That's short term.
Got it. Yeah, okay. Thanks.
So if it does and for these figures, it's like you said, it's not too much change for the Walmart between 2005 and 2004. It doesn't mean it's less big figures.
Now it's all of the same figures. The numbers are very similar.
Yeah, it's similar.
And so the number change in terms of liquidity risk.
Yeah.
So the risk is same as last year.
Yeah.
And what I said just now, sir, if we go back to 10 years,
Yeah.
Walmart has this kind of ratio for 10 years.
Mm-hmm.
So company has been operating under this kind of situation for a long time period.
Yeah.
So even though this ratio of levels is 1, but it may not be a problem for Walmart.
Yeah. Okay. So which means we will have a lower financial risk.
Yeah. Okay.
Because they are not changing so much, so it's
Well, so again, if we compare these two, certainly Target has better ratios. That's pretty risk. But even for Walmart, under these ratios, they have been operating for a long time periods. So just they know how to manage this risk. That may not be a concern for investors.
it means that even though the current ratio is low, but they're already performing really well in this ratio for like decades, so it's perfectly fine to them. So it's like low liquidity risk and low financial risk.
Right. Okay, so that's good. No. There are different ways to compare the ratios here.
Okay.
So that's why we say, you need to understand how we should compute it. So here here financial leverage is total assets divided by equity.
Okay.
Okay. So in this case,
Total.
total assets divided by equity.
Okay.
Okay. So in this case, slightly higher, but very much the same.
Yeah.
Okay. Now, what's this size here?
Mm.
So this is liability to equity.
Mm-hmm.
This debt to equity. Debt are this interest-bearing, short-term debt, long-term debt.
Mm-hmm.
Now in this case, in both cases, target is slightly higher.
Yes.
So suggesting they have a more debt than Walmart. Now combined with this, could be Walmart has more short-term liabilities
Oh, okay.
than long-term debt compared to Target. So that's must be
Oh,
some
okay.
kind of a combination of a short-term long-term debt.
Okay, so you combination these two figures, so you have which one has shorter, one long, and which one has
Now, why is it short-term, long-term debt? They also could have some non-interest-bearing liabilities, like provisions, like long-term payables. Those are not debt, but they are still your liability. Okay. So here we only look at the debt. Okay. And this is net debt. And net debt is also debt minus cash. So it also depends on how much cash you have.
okay. So that part means the target have more debt than Walmart.
That's right. In terms of debt, Target has more.
And what is the effect about target and Walmart?
No, it's not that big. The difference again, so it's come to the second decimal points. Okay.
Okay.
So it's very small. I would say they're very much the same.
Yeah.
You don't need to worry that much. Okay.
Okay.
These two come in terms of debt ratio, they're kind of same.
So for this one is Walmart may invest more efficiently. Is that?
Yeah. So here, the current ratio is lower than 1. So in this case, Walmart have more current liabilities than current assets.
Yeah.
Okay. And you remember working capital is your current assets minus current liabilities. So effectively, you are using your current liability to finance your current assets. Okay. So your working capital in this case is kind of negative. You are using other people's money to finance your working capital, like inventory. Okay. That's easy to understand. You don't spend your own money to pay inventory. You actually get from your suppliers because you delay the payments. Okay. So that's the situation here. But this is more about this liquidity ratios or liquidity risk, the ability to pay short-term debt, short-term liabilities.
我说这块这个答案没有是吗？就是没有答案，
这个就没有答案，这个就是上课讲的。
上课讲啊，因为记得很多很杂，那要是考试的时候有这样的
OK， 这你要怎么做呢？先回去把书看了。首先就是这样，很多人搞这个搞不定这是什么意思，这个搞不清楚，后面没法弄。所以先把书看，告诉每个人什么意思。哎，然后再回过头来看这个，让你自己的分析，比如说，哎，这个高是什么意思？说这我刚讲的嘛，这个地方差别更多 debt， 那代表有什么？代表financial risk，对吧？然后同样这个利率coverage ratio 是这样子的，那么越高说明你这个还债能力越强，
对，
你们的 risk 更低一些，所以这是最基本的。
对，这个 risk 高，这个 risk 低，
不是一致的呀。那这个高说明你有更多的 debt， 有更高的 risk， 这个低说明你还债能力弱，你也是更高的 risk。对，这是一致的。就是每个人都要这样看懂，只有这次第一步搞完后，你才能搞清楚这个东西是告诉你什么东西。然后回到我们的后面上课第3步也是看到这个 change 以后，为什么会这样对？
然后就分析它的 change。对。那考试就像这种题，就是所有没有想起来的点都要想起来。
基本上是。
基本上。
对，因为就是考试的时候呢，你的公司我们给的都很简单，就你只要你想到了 relevant 的 point 都懂就行。
好。就是这一块，其实我有个点没听到，就是那个 for private company，就是是不是就是说他们就是没有 market value 的 stock， 所以他们要用这个？对，
是的。
这块有一个点，就是那个margin
OK， 这个你可以弄完，没有听完。
不用管。
对，这个弄完，这个是。
因为我差的是什么？差多少？什么可以强制把它弄
是
差百分之几那个我没听到。
这个你懂吗？
哦，不用问。
对。
哦，行。对，这些反正就是回去要看书。
书要仔细看，就是
那个书前2个课，我看老师没有，就是有电子的在那个 Blackboard 上，这个好像没有。
哦，我待会儿回去把它放上去。
哦。然后就是看您放上去的东西。
啊，对对。
刚刚那个姑娘什么问什么要买那个，那是啥？
这个书后面每一章后面它有一些那个 multiple choice questions。
对。
他们想要答案。答案在那一个叫 workbook。
workbook。
那上面有。那个书呢，就是我们图书馆，就是 workbook。我们图书馆有的是我们图书馆有的是那个 workbook for the second edition。我们用 textbook 是 third edition。所以有一些会配不上。但是基本上你找一些 relevant 的 question 做一做就可以了。而且那上面 question 都太简单了。所以其实没太大，你知道自己练一下，其实很多人在书上直接找答案。如果这个时候你实在要找的话，你去就是在 Amazon 上面可以买到。电子版要30块钱。
所以就是那个其实
不必要。
没有什么。
对，你直接把书多看2遍就可以。
那就是说书上面都是理论，要是到时候练习的话，
它后面这个书不都是理论，它很多就是都给你的。
后半部分有题。
你像这今天 ratio 全是告诉你怎么算，怎么分析。
行，那回头把框架子那个分析自己做一下。
对，你可以自己把框架子做一做。
去靠做，然后问你。
对。
好，谢谢。